Hello everyone, welcome back to my YouTube channel, Dae Hwang. Ever wondered why the wealthy seem always find ways to minimize their taxes, while the lot of us are holding the bills? Today we're diving into the ways rich people avoid paying taxes. That's right, get ready to uncover the strategy and secret that billionaires use to keep more of their hard-earned money. From smart investment to the trust funds, you will learn about techniques and tactics that the rich use to cut down their tax bills. If you're curious about the ways and how strategy work and how you might be able to use them yourself, stay tuned until the end of this video, ready to find out how the wealthy stay ahead of the tax game. Let's get started.
Benjamin Franklin famously said, "In this world, nothing can be said to be certain except debt and taxes." Yet, when it comes to taxes, the wealthy seem to have found ways to soften this certainty. With the help of skilled accountants and financial planners, the rich often navigate the complex tax code to minimize their tax burden, sometimes pay little to no taxes at all. Over the years, we've observed these strategies closely, and while this isn't financial advice, it's worth noting how these methods have contributed to the rapid growth of their wealth. Understanding these tactics could be beneficial to anyone looking to better manage their finances in the long run. Here are 13 methods the rich use to reduce their tax liabilities. Starting with number 1, everything you use is owned by a business. The first golden rule of tax optimization is deduct everything. Here's how it works. If a business needs something to operate, the money spent on it isn't taxable. You want a new car? If your company needs it too, let the company purchase it, and you will get use it because it's necessary for running the business. This strategy allows you to enjoy the benefits while reducing your tax liability. By deducting these expenses, the wealthy reduce their taxable income, allowing them to keep more of their money. These expenses are essential for the business. Travel, hotels, and flights are necessary for the business trips. Homes, office expenses, utilities like internet, health insurance premiums, and even dining out can be deductible. The more expenses you can deduct, the least taxable income you have. Number 2, they invest it all. The wealthy don't keep cash idling unless they need it for something specific. Here's the golden rule. When it comes to taxes, reinvest this profit isn't taxed. For instance, if your company is set to make 10 million in profit, and before fiscal year ends, you decide to reinvest that 10 million back into the business for further growth, you don't have to pay taxes on those 10 million. This is how companies rapidly expand. As the business owner, your net worth skyrockets with the minimal taxes being paid. Number 3, move to a low or no tax area. Many people underestimate the significant impact of relocating to a place where you can keep more of your money. In the past, it was common to move to the tax havens like Dubai, Monaco, Cayman Islands, or the Bahamas to benefit from their favorable tax policies. These locations allowed individuals to retain a larger portion of their earnings, making them attractive options for the wealthy looking to minimize tax liabilities. This country have no income tax, meaning you don't have to pay any taxes on the money you earn. However, there's a catch. It's usually very expensive to move there, which is why the rich often have an advantage. The cost of living in a place like Dubai is incredibly high, but when you factor in the tax saving, it can be still worth it if your tax burden is sustainable enough to justify the move. Number 4, charitable donations. The fourth rule of taxes is that money donated to charity isn't taxable. This is why nearly every wealthy individual owns a foundation of some kind. In their defense, the state has often proven to be an efficient manager of money. So instead of giving your money to the state, you're better off using a charitable foundation to ensure your funds to have a positive impact on your community. But here's where it gets even more interesting. Even these tax-exempt foundations have deductible expenses. They need resources to function. So you could donate land, vehicles, or other access to a charity you own, and it still counts as a charitable contribution. As a head of charity, you have significant control over how these assets are used, allowing you to maximize the impact while benefiting from the tax deductions. You can still use the same car you donated on paper. Number 5. Send it overseas. This is strategy used by giants like Facebook, Google, and Apple. They set up by companies in tax-friendly countries like Ireland. These overseas entities own these intellectual property, and this US company has to pay a license fee to the Irish company each year to continue developing and selling its products in the US. This creates a legitimate deductible expense for the US company, effectively moving money out of the US economy and into Ireland, where they end up paying only around 1% in taxes, or even less with further optimizations. If you live in a low income tax country, you can set up a local company there and invoice your use as subsidiary for service rendered, thereby minimizing the tax burden in these use ads. Many tech giants prefer to pay fines rather than paying their full taxes, which brings us to an interesting perspective. A fine is essential for tax for doing something wrong, while a tax is fine for doing something right. Number 6. Buying art. Here's something only wealthy truly understand. The art market is one of the last major unregulated markets. When you buy a piece of art, it counts at an expense, and as you've learned, many expenses can be deductible, but there are more to it than meets the eye. Let's say you earned 1 million this year and decide to spend it on a 1 million painting. Since the expense matches the income, there's no money left to be taxed. Fast forward 3 years, and that same painting is now appraised at 6 million. Instead of selling it for a profit, you decide to donate it to a museum, or better yet, your own art foundation. This means you just got a 6 million tax deduction. If you're still earning 1 million a year, you've just saved an additional 5 million in non-taxable income on the perfectly legal. And if you want, you can go through the process again, continually to leverage the value of art to minimize your tax burden while simultaneously increasing your wealth. Let's say you decide to sell that painting at its 6 million valuation, earning 5 million profits. Normally, you don't expect to be taxed on that profit, right? Well, once again, the government provides a loophole for the super wealthy. If you take the entire 6 million from the sale and use it to buy more art, you don't have to pay any taxes on the profit you make from the sale. This is why the rich invest heavily in art. This is kind of insider information that you can only find on my YouTube channel. Please now like and subscribe if you're really into this video, okay? Number 7. Invest in a family limited partnership, FLP. Did you know that setting up a family limited partnership, FLP, can a strategic way to manage and transfer the wealth? It's true. An FLP allows you to consolidate family assets such as real estate or family's business while maintaining control over those assets. You can give partnership interest to your children or other family members, effectively transferring wealth without the immediate tax burden. If the value of the partnership interest is less than 50,000 per year, you don't need to report it to IRS as it falls within the annual gift tax exclusions.
This allows you to transfer a significant amount of wealth over time without triggering gift taxes. While $50,000 might seem modest, remember this strategy is designed for long-term wealth optimization, often utilized by super rich. As of 2023, the lifetime gift tax exemption is 2.92 million per individual, meaning you can transfer up to this amount of tax-free over your lifetime. By gradually gifting partnership interests that fall below the annual exclusion, you can move a considerable amount of wealth into the hands of your heirs while potentially reducing the taxable value of your estate. This strategy provides a powerful way to protect family wealth across generations while minimizing tax liabilities. Number 8. Multiple nationalities with no fixed residence. Now, this is probably the saddest and most complex strategy on this list, but it's one that many have successfully used worldwide. Typically, you're required to pay taxes in your country of residence, your home country. But what happens when you no longer have a home country? Many ultra-wealthy individuals choose not to have a fixed home country, despite owning properties all over the world. By holding multiple nationalities and not maintaining a permanent residence, they navigate a legal gray area where they minimize or even eliminate their tax obligations. This strategy allows them to live globally, enjoying the benefits of various countries without being tied down to any one tax system. When institutions request proof of arrest, some individuals provide documentation from property they own in a place like Thailand or Bhutan. These documents are often in different language and may be overlooked by governments that aren't inclined to scrutinize further. Others may purchase a large yacht and use it as their primary residence, one day anchored off the coast of the Monaco, the next day international waters. While having multiple nationalities can offer various benefits, and multiple passports can be advantageous, we don't necessarily recommend going fully off the grid as the long-term solution. Number 9. No cash but access to borrow against. Here's why. Many wealthy individuals are rich but cash poor. Instead of withdrawing cash from their businesses, they leverage their access to borrow against. This approach allows them to maintain liquidity and continue borrowing their wealth without having to liquidate their investments. Rich individuals often avoid withdrawing cash from their investments because doing so would trigger taxes. Instead, they leave their money in stocks or other assets. When they need cash, their relationship with their bank becomes crucial. Wealthy individuals can walk into the bank, showcase their assets such as cars, stocks, and real estate, and confidently request a loan. The bank, seeing the robust portfolios, provides quick cash. Seeing this is a loan, not their own money, they don't own taxes on it. They simply need to repay the loan when handled through a company rather than personally. These mutually beneficial advancements can last a lifetime. Number 10, hold it in your privacy coins. Cryptocurrency is revolutionizing wealth transfer and security. The ability to store $1 billion on a digital stick and transport it to a place like Singapore is truly remarkable. While Bitcoin or Ethereum are heavily regulated, with the measures in place for transparency and linking the wallets to individuals, the landscape is evolving. Moreover, profits from cryptocurrency sales are taxed at only 10%, making it a favorable option for those looking to maximize their financial strategy while navigating legal tax advantages. In many countries, privacy coins offer a better return than some traditional assets, especially when considering industry price appreciation. The rise of blockchain technology has introduced a new category of digital currencies known as privacy coins. These currencies can be exchanged, stored, and transferred completely anonymously.
Are not illegal, their legality varies jurisdictions. The principle here is that once you've earned your money legally, you should have the right to transact it without external oversight. Number 11, filing your bankruptcies. While bankruptcy can be expensive, tedious, and complex for most people, the super rich know how to navigate it effectively. Here's a simple example. Imagine you're a successful lawyer earning $250,000 a year. You own $1 million home and have saved an additional $1 million. You decide to invest in $10 million office building, putting down $1 million and securing $9 million loans from the bank. Unfortunately, a year later, the pandemic strikes, causing all of your tenants to leave. You still owe the bank $9 million. In such situations, the wealthy can strategically file for bankruptcy. This process allows them to manage their financial liabilities more effectively, leveraging their knowledge of the system to minimize personal loss while restructuring their business debt. To complicate matter further, if the office building you bought is now worth only $5 million due to decreased demand, it's owned through the company. You can file for the bankruptcies while the bank will repossess the building and it may strain your relationship with them. Bankruptcy laws protect your personal assets. They can reseize your home and garnish your wages. This distinction highlights the difference between being broke and being poor. Rich individuals can appear broke on a paper with their net worth in the negatives, but they will never be poor. If you don't rely on the bank, paying everything in cash is another option. The financial loss from such investments can be tax deductible, meaning you don't need to pay taxes on your income until you recoup the amount you lost. Number 12, claim your yacht at your second home. Rich people often claim their yacht at a second home for the tax purposes. This allows them to benefit from various tax deductions related to property ownership and living expenses. By designating the yacht at a second residence, they can leverage its costs and expenses for tax benefits while enjoying a luxurious lifestyle. Here's an interesting observation. Governments tend to favor homeowners while being least friendly toward the super wealthy who like to flaunt their fortunes. They are keen on taxing the showy display of wealth. To counter this, rich individuals often declare their yachts as a second home to benefit from more favorable taxation rates. Technically, if the yacht has sleeping, cooking, and toilet facilities, the IRS treats it as a second home. This allows them to use it as a holiday home during trips to places like Mykonos, while still taking advantage of tax benefits. Similarly, motorhome can be used in the same way, though you don't see many ultra-wealthy people buying motorhome these days. Number 13, using a trust to avoid estate tax. Among the wealthy, there is saying that a person doesn't realize how much they have to be thankful for until they have to pay taxes on it. One effective way to manage and minimize estate taxes is through the use of trusts. By placing assets into a trust, they can transfer the wealth to beneficiaries while avoiding significant estate tax liabilities. This strategy ensures that more of their wealth remain intact for the future generations. Unless you're wealthy, you might not be aware of this. When a rich people dies, the state can impose an estate tax of up to 45% of the wealth they want to pass down to their heirs. This is known as the state tax. In the US, you are considered wealthy if your net worth exceeds $11.7 million. For those which less than the amount, this state tax either doesn't apply or is significantly lower. While $11.7 million may seem substantial to the average person, we are talking about the real of the billionaires, and is likely
we'll see the first trillionaires in our life. With fluctuating trends, it's conceivable that many will eventually become millionaires. To protect their wealth from such substantial estate taxes, the wealthy often use trusts. By transferring assets into a trust and fulfilling specific conditions, those assets are legally removed from their estate. This means these assets are not subject to estate taxes when passed on to heirs, effectively preserving more of the wealth for future generations. When you place assets into a trust and meet specific conditions, those assets are no longer considered part of your estate. This means you are not subject to estate taxes when passed down to your heirs. Additionally, trusts can protect your wealth from being mismanaged by your heirs, as the control remains with you while you're alive. You can set up the rule in the trust to grant your children gradual access to the assets under certain conditions, such as turning 25, 13, 14, or graduating from school.
And there you have it. 30 ways the rich people avoid paying taxes. I hope you found this insight valuable and that they give you a fresh perspective on financial planning. If you enjoyed this video, make sure to hit that button and subscribe for our content on smart money management. Got questions or suggestions for future video? Drop them in the comments below. I'd love to hear it from you. And now, see you in the next video.